Welcome to yet another informative podcast on everything private equity. Today's topic is, what are the common misconceptions about private equity investing? Private equity has long been associated with high-risk, high-reward investments, and while there is some truth to that perception, there are also many misconceptions that need to be addressed. One of the most common misconceptions about private equity investing is that it is exclusively reserved for the ultra-wealthy. While it is true that private equity investments typically require a minimum investment amount, there are ways for everyday investors to gain exposure to this market. For instance, private equity mutual funds or exchange-traded funds, ETFs, allow investors to pool their capital and invest in a range of private equity assets across different sectors and geographies. These investment vehicles provide access to private equity opportunities that would otherwise be out of reach for most investors. Another misconception is that private equity investments are only suitable for long-term investors. While it's true that private equity investments often require a long-term investment horizon, there are a range of private equity strategies that cater to shorter-term investors as well. For example, private equity funds focused on distressed assets or turnaround situations may have shorter investment horizons than traditional buyout funds. These funds aim to identify undervalued assets, fix the underlying operational or financial issues, and then sell them for a profit within a relatively short period of time. Some people also believe that private equity is a black box, and that investors have no visibility into how their money is being managed. However, this is not entirely accurate. While private equity funds are not subject to the same level of regulation as public companies, they are still required to provide regular updates to their investors on the performance of their investments and their overall fund performance. Additionally, as an investor, you have the right to ask questions or seek clarification from the fund manager at any time. Another misconception about private equity investing is that all private equity managers are the same. While there are certainly common traits that are shared by many successful private equity managers, such as a rigorous due diligence process and a disciplined approach to risk management, there is plenty of diversity within the industry. When evaluating private equity funds, it's important to look at factors such as the fund manager's track record, investment philosophy, and the particular niche that they operate in. Finally, some people believe that private equity investing is only for sophisticated investors who have access to inside information. While it is true that private equity investors often have access to proprietary information that is not available to the general public, this does not mean that private equity investing is restricted to a particular group of investors. As mentioned earlier, there are a range of private equity investment vehicles available to retail investors. In conclusion, private equity investing can be a highly rewarding asset class, but there are also many misconceptions that need to be addressed. Private equity is not as exclusive, opaque, or risky as many people believe, and there are many options available for investors to gain exposure to this market. It's important to do your due diligence, evaluate your risk tolerance, and consult with a financial advisor before making any investment decisions. Thank you for listening, and we hope you found this podcast informative.